We're going to show you how to make $150,000 off one property.
And this is going to be on a 5-plex, so that's $30,000 a unit.
We're the Investor Couple. I'm Mel.
I'm Dave.
And we're the
Investor Couple.
On this channel, we teach regular people just like you the secrets to time freedom, location freedom, and financial freedom through real estate investing.
We put out a new video every single week, so make sure to subscribe and hit the bell to be notified, right? We want to give you a lot of content, and we go live every single week, so you can come on and get notified and ask us any question and we'll answer it.
That's right. By subscribing and hitting the bell, you will be notified every time we're live and we'll answer your questions.
So today in this example, we're going to talk about a 5-plex that we purchased using none of our own money, no joint venture partners, 100% control, and we actually made $150,000 of profit. So if you're interested, we're going to show you all about this in today's video.
Yes, and make sure to stay right till the end, because at the end we're going to share the most important tip of all. So let's break down the deal. First mortgage.
So take the idea of having to use a bank and throw that out the window, because in this deal we did not use a bank whatsoever in the beginning.
Yeah, so if you've ever thought that, hey, I need a bank, they won't approve me, they won't do creative financing, know that there's absolutely a way around this.
So in this scenario, the owner actually held a first mortgage of 80% loan to value. So that's 80% of the agreed upon purchase price.
Now, if you're thinking, wait a second here, Mel, you said 80% first mortgage, but you bought 5 units. How's that possible? When you're doing creative financing, because there's no financial institution involved, you're very flexible. You can actually have 100% finance still through the seller. So this is how we were able to get 80% financing.
Now, one of the questions I know will be put in the comments below, so I might as well just address it now. This deal was actually a private deal, so there was no realtors involved. It was strictly lawyer to lawyer, right? They end up doing the agreement for purchase of sale and that type of thing. So you can do this without realtors, even though we love using realtors as well.
Now, why would the owner want to do that? Well, because it benefits them. It's a win-win. We were able to get into this deal using none of our own money, which we love doing, but most importantly, they won as well. And how did they win? Well, they get to defer their taxes, for example. They get paid interest every month as well, so it benefits them just as much as it benefited us.
They got used to receiving a monthly check or payment from the tenant for rent, and now they end up receiving a monthly payment for a mortgage from us. So it helps the owner absolutely.
Now that we got the first mortgage, how do we come up with that remaining 20% as the second mortgage?
So in this deal, this particular scenario, we actually utilize secured funds. So in Canada, that would be called Registered Retirement Saving Plan, which is RRSP. And for America, it's called 401k. Same difference, okay? Now, those secured funds were utilized in the form of a mortgage as a second mortgage for our down payment.
And again, why would anybody want to do that? Because it benefits them. So perhaps they weren't happy with their interest rate that they were receiving. We're going to offer them a more attractive rate, and that doesn't matter for us as long as the deal still makes sense with those numbers.
So pro tip here, before you start looking at deals like this, just know that we talked to the seller who's holding the first mortgage beforehand, letting them know that we were going to be putting a second mortgage behind as our down payment. So make sure you talk to the first mortgage holder before you go doing all this homework and running around and legwork, because if they don't want that, it might kibosh your deal.
No, great point, Dave, because you want to be completely transparent with your lenders. Don't hold any information back, so be transparent from day one to have that positive relationship. Now that we talked about financing the deal, how did we get the lift? And let me explain what the lift is. The lift is the difference between your purchase price and your new appraisal price. Essentially, what you want to do, you want to lift the value of the building.
You need to do a few things, and we call this renovating and repositioning the asset. Now, renovating, obviously very simple. It means doing either full-blown renovations like a flip or a gut job, or it could also mean some minor cosmetic things, right? Like some paint, some countertops, maybe a vanity in the washroom. This is going to depend on the particular deal that you're purchasing and doing this to. repositioning the asset. This is something that will actually take a lot of calculations ahead of time to make sure that you're going to be able to do this and how long it's going to take you to do this. Repositioning the asset basically means getting your income up and your expenses down.
How do you do that? Let's take increasing rents, for example. If you have a tenant move out and you've put a little bit of TLC into the place, you'll likely be able to ask for a higher rent. And look for things, look for deficiencies. Perhaps light bulbs can be replaced so that way you're spending less on monthly hydro.
So now to wrap up this section, to get that forced appreciation, what do you need to do? You need to renovate and reposition the asset. So in this scenario, we did that, and we can move on to the next phase. So now the first step that you need to do in the refinance is talking to your either financial institution or mortgage broker. They are going to order an appraisal. No, you probably will not get to choose the appraiser. That will be the institution that will choose the appraiser and order it for them to go complete that. Once that new appraisal comes in, the financial institution, in this scenario a fiveplex, so it's a commercial, will give you a maximum of 75% loan to value. And again, stay to the end because we're going to be going through the whiteboard. So what does that mean? What do you do with that 75%? Well, what you end up doing is paying back all the other lenders. So that first mortgage that was the seller up to 80% loan to value, the person who invested their secured funds, whether it be RRSP or 401k, you also pay them back as well. So with that new first mortgage of 75% loan to value, you pay out all that existing creative financing.
After all the expenses were paid, we still made $150,000 off this fiveplex.
So this is over and above, like Mel said, paying everyone back, paying everyone out. We were left with $150,000 refinance money. Now, the most important thing about a refinance, and I'm not an accountant, but I get very excited about it, is refinances are a tax-free event.
This is why we love the refinancing stage. Did you notice that Dave and I did not mention once that this was a joint venture deal? And guess what? That means that we are the sole owners, which means we get to keep 100% of that profit.
Yeah, that $150K that we talked about is all ours. And that's why we love doing it this way. Now, after refinancing, paying everyone out, we still own the asset and control the asset, which is so important.
Both had a goal of quitting our jobs in our 30s, so monthly cash flow was also very important to both of us, and that's exactly what we got with this property.
So that is just another point of why this deal was amazing, because again, we solely own it, we get the monthly cash flow. Now the next thing is once we paid everyone out, the bank makes us keep some equity. And in this scenario, we got 75% loan to value, so we still have 25% equity in the deal. Think of that. No money in, and now we still have 25% equity in the asset. And now, the last thing before we go to the whiteboard is infinite. Infinite return on investment. What do we mean by this?
Infinite return on investment is when you put nothing into the deal and you get a huge appreciation.
Infinite. When you don't put anything in, but the asset keeps giving you monthly cash flow.
Now let's head over to the whiteboard. Let's break down this deal. We purchased this fiveplex for $293,000.
So 293 times first mortgage of 75% loan to value comes up to $219,000 times 25% second mortgage comes up to just over 73,000. So we'll just leave it at 73. Again, keep it easy. So plus, let's calculate as well, we had the renovations, so $12,000, so 293 plus $12,000, and we had, let's say, closing costs and legal fees, so about $4,000. For a total of 293 plus 12,000 plus 4,000 equals roughly $309,000. That's what we're into this property for, $309,000.
Our new appraised value is $612,000.
Let's take that number. Let's see how big our lift is. Remember, so $612,000 minus our purchase price of $293,000, $319,000. That is the actual lift. And let's keep on going with this deal. If we take the $612,000, the new appraised value that the appraiser went through and gave us, with the new mortgage of 75% loan to value, because now we're bringing it to an institution and they'll only give us 75 maximum, that comes up to $459,000.
Yeah.
So what we'll do with that number is we'll deduct how much money we're into the deal, which again is 309, equals $150,000.
Yes, and that's the power of creative financing, $150,000 after all expenses into the deal.
So this is everything we touched on in the video. This is over and above tax-free money. This is in our pocket. So this is the power of utilizing creative financing and not using any of your own money to buy real estate.
Yes, and because we are buying and holding this property, we get to continue to cash flow every single month on top of this amount. Now let's head back to the studio.
We're back from the whiteboard. So please comment below, what did you like about this video? What other types of things you'd like to see? We'd love to hear it.
If you want to see us analyzing more deals on the whiteboard, make sure to check out the next video. I'm Mel.
I'm Dave.
And we'll see you there.